Imagine making one business decision today that could affect your company's profits, cash flow, debt, and overall financial health for years to come. The question is, how do you know whether that decision will help your business or create financial problems later? In this video, you will learn how to create a three-statement financial model for your business. What is a three-statement financial model? A three-statement financial model is a spreadsheet that forecasts a company's future financial performance by connecting three essential financial statements: the income statement, the balance sheet, and the cash flow statement. Instead of preparing each statement independently, a financial model links them together so that one financial event automatically affects all three statements. If projected sales increase, the model updates revenue, profits, assets, liabilities, equity, and cash flow without requiring manual calculations across multiple spreadsheets. Think of it like the human body. Your heart, lungs, and brain all perform different functions, but they constantly work together. If one organ changes, the others respond. The three financial statements work the same way. A change in revenue affects profit. Profit affects retained earnings. Retained earnings affect equity on the balance sheet. Cash collected from customers affects the cash flow statement and changes the company's cash balance. Everything is connected. That connection is what makes financial modeling so valuable. Without a connected model, businesses often rely on isolated spreadsheets that require manual updates every time assumptions change. This increases the risk of errors and makes forecasting extremely difficult. A properly built three-statement financial model eliminates much of that manual work because every calculation flows automatically through the entire model. Why financial modeling matters? Consider a small landscaping company that has experienced steady sales growth for several years. Encouraged by strong demand, the owner decides to purchase new trucks, hire additional employees, and lease a larger office. On paper, the business appears to be growing rapidly. Sales continue increasing every month, and the income statement shows healthy profits. However, several months later, the owner suddenly struggles to pay suppliers and employees on time. Even though the company is profitable, its bank account continues shrinking. The owner becomes frustrated because the financial reports suggest everything is going well. The problem is that profit and cash are not the same thing. Customers may take 60 days to pay their invoices, while payroll, rent, fuel, insurance, and equipment payments must be made immediately. The company is earning profits, but those profits have not yet turned into cash. A three-statement financial model would have revealed this problem long before cash became tight. By projecting future cash balances, the owner could have delayed equipment purchases, negotiated better payment terms, or secured financing before a cash shortage developed. This is one of the biggest reasons businesses create financial models. They allow owners to identify future financial problems while there is still time to solve them. Rather than reacting to financial emergencies, business leaders can prepare for them in advance. Understanding the three financial statements. Before building a financial model, it's important to understand the role of each financial statement because every part of the model depends on them working together. The income statement measures a company's financial performance over a specific period. It begins with revenue, subtracts the cost of producing goods or services, deducts operating expenses, interest, and taxes, and finally arrives at net income. In simple terms, the income statement answers one important question: did the business earn a profit during this period? Most financial forecasts begin with projecting future revenue because nearly every other calculation depends on expected sales. The balance sheet provides a snapshot of the company's financial position at a specific date. It shows everything the business owns, everything it owes, and the owner's investment in the business. Assets include items such as cash, inventory, equipment, buildings, and accounts receivable. Liabilities include loans, accounts payable, and other financial obligations. Equity represents the owner's share of the business after liabilities are deducted from assets. The balance sheet follows the accounting equation: assets equal liabilities plus equity. Every financial model must satisfy this equation at all times. The cash flow statement explains how cash moves through the business. While the income statement measures profitability, the cash flow statement tracks actual cash entering and leaving the company. It separates cash activity into three sections: operating activities, investing activities, and financing activities. This statement answers another critical business question: where did the cash come from and where did it go? Many profitable businesses fail because they run out of cash, making the cash flow statement just as important as the income statement. How the three statements work together. The real power of financial modeling comes from linking these three statements together. Consider a simple example. Imagine a company expects sales to increase by $100,000 next year. The additional sales increase revenue on the income statement. Assuming expenses remain proportionally similar, net income also increases. Since net income eventually flows into retained earnings, equity on the balance sheet increases as well. Now, suppose those customers have not paid their invoices yet. Instead of receiving cash immediately, the business records accounts receivable as an asset. When customers finally make their payments, accounts receivable decreases, while cash increases. Throughout this entire process, every statement updates automatically because the numbers are connected. This is why experienced financial professionals rarely build isolated financial statements. A properly linked financial model ensures that every business activity flows through the income statement, balance sheet, and cash flow statement exactly as it would in the real world. If one assumption changes, the entire financial picture updates instantly. Once the financial model is complete, it becomes much more than a forecasting spreadsheet. It becomes a decision-making tool. Instead of accepting one future outcome, you can test multiple possibilities. What happens if sales grow 15% instead of 8%? What if raw material costs suddenly increase? What if customers take 90 days to pay instead of 30? What happens if interest rates rise? What if the company opens a second location next year? Because every assumption is connected, the entire model updates within seconds. This allows business owners to evaluate opportunities, prepare for risks, and make decisions based on measurable financial outcomes rather than assumptions or emotions. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.